Hello, and welcome to the Building Organizational Resiliency through Financial Management session. I'm Bhumit Patel, Senior Vice President of Finance and Accounting at OFN, and will be serving as the moderator for this session. In this session, our amazing panelists will share some lessons learned and best practices on how to proactively position your CDFI to deliver impact through strong financial management. And as we get started, I want to note that we are recording this webinar and provide a few housekeeping tips. On the top right-hand side of your screen, you will see icons for the chat and Q&A features. We encourage you to use the chat feature to comment, introduce yourselves, and interact with other participants throughout the session. Please feel free to submit questions using the Q&A box throughout the program. We will address audience questions immediately following this session in an interactive Zoom room. In that room, each participant will be able to use their video and audio to interact with the panelists and other attendees. Slide, please. And before we begin, I'd like to note that as part of OFN's Next Generation CDFI Workforce Initiative, we are developing tailored professional development resources and opportunities for CDFI practitioners, such as a new in-person and virtual trainings, as well as a career center. We'll also be producing over 30 toolkits over the next couple of years to share leading practices on a variety of topics. You may have seen our first toolkit, CDFI 101, which was released last month and can be accessed via the event homepage or the link in the chat. In the coming months, we will be releasing a series of new toolkits, including one related to the topic of today's session, CDFI Financial Management. The new toolkit will be released in Q2 of 2023 and include information and leading practices around CAMEL 101, as well as key CDFI accounting definitions and concepts. It'll also have a new Excel tool developed by OFN featuring KPI Excel dashboards and a starter financial projection model that can be adapted to your CDFI's needs. When paired with our existing cash management toolkit, which provides a guide, webinar recording, and 3 starter Excel tools to assist with cash flow modeling and asset liability matching, we are aiming to provide a set of tools and resources that CDFI financial managers can use to build the organizational resiliency of their CDFI. And last but not least, to help practitioners tailor these concepts and tools to the needs of their CDFI, we'll be offering a half-day in-person financial management workshop adjacent to OFN events starting in April at our Phoenix regional meeting. As a reminder, you can access and download OFN toolkits for free via CDFI Connect. Once you log into CDFI Connect, navigate to the Resources drop-down menu and select OFN Resources. If you don't have a CDFI Connect account, you could join for free at the link being shared in the chat. A list of toolkits that are currently available can be found in the one-pager on the Attendee Hub. So without further ado, let's dive in to the conversation. Our panelists are Julie Mahowald, Chief Financial Officer at Housing Trust of Silicon Valley, Dana Moore, Chief Financial Officer at NeighborWorks Capital, and Ian Pumaras, Chief Financial Officer at Council for Native Hawaiian Advancement. Thank you all for joining us. So the first question is, good financial management starts with a financial strategy and business plan. Julie and Ian, how do you approach developing your organization's financial strategy? Why is this important, and what advice do you have for other CDFI financial managers as they develop their strategy? Julie, let's start with you.
Great, thanks so much, Bhumit. So how we, why we think it's so important, planning and forecasting, is that with rigor in planning and forecasting, it allows us to be comfortable in times like these or times like a pandemic to either stay the course or if we need to pivot. While all these forces in the ecosystem or economy change, having that rigor in planning and forecasting is super important. Our planning process sets the stage for us to adapt to these things. And so we center on our strategic plan and strategic goals. And every year we sit down and look at where we are with our strategic plan and goals and how we've measured up and assess whether we need to pivot or looks like everything is going, and we recommend pivots to our board. And then finance leads the annual operating plan development. We include a timeline so that we can sync that up with the budget. So we have a budget delivered to our board by the end of our fiscal year. And then in the operating process, we also try to encourage all members of each department to be part of the planning and be part of developing goals as well as resources that you're going to need to achieve those goals, including any resources you might need from other departments. We try to make sure that's all wrapped up in the operating plan goal setting. And we also work with our teams to develop SMART goals. That can be really tricky, but we want to be able to measure and make sure that our goals are achievable that we're setting. Once we get all the teams to develop an operating set of goals, we roll that up as a senior team, and we come up with our top goals for the year. And then those measurements that have come out of the SMART goals, that helps us set the metrics and our KPIs. We use the resources needing to set the expense plan. And then the metrics also, such as program deliverables and how much lending we'll be doing each year, help us build a revenue plan. We put that all together. Once we come up with an acceptable P&L, we develop a balance sheet forecast and a capital plan, which helps us understand our interest expense and interest income on undeployed funds. And then we pull all that together. We go to our finance committee, and then of course to our board with our operating plan and budget for the year. So that's how it all fits together. And then from that, because we have these models all set, it's all been signed off, we've been in good communication, and it's kind of been a bottoms-up process. That really helps us to then reforecast our revenue monthly. We do that. We take a look at where we are, what we've done, what our pipeline is, what loans are maturing, and then we can reforecast our revenue monthly, and then just look out for the rest of the year. And then we sit with each department and reforecast expenses quarterly. And all of that really helps us just to, know where we stand. And then we can also do scenario testing with these models. And if we're looking ahead, we want to understand what are the impacts of changes in the environment, then we can do scenario testing. So overall, that planning process and rigor just helps us be nimble, which is one of our values at Housing Trust, and then to be able to give management a clear view where we're headed.
It's important to be nimble these days. Ian, how about you?
Our situation's a little bit unique because we're actually developing our financial strategy in the midst of unprecedented growth for the Council for Native Hawaiian Advancement. Over the past 2 years, we have really seen tremendous growth in business from a mere $11 million organizational budget to now $90 million in just, again, 2 years. And it really did happen almost overnight. And we were caught with almost no financial strategy to take full advantage of the additional businesses that were coming in. And growth came mostly from temporary government contracts. But soon as we could establish strong balance sheet and show financial viability in our organization, additional money started to come in to CNHA, especially in our lending activities, such that in the past 2 years, we have grown our CDFI loan fund by at least 300%. And in developing our financial strategy, there are a few things that we're looking at. First and foremost, we ask the question, how are we generating our revenues? What are the limitations of the funds that are coming in? What programs and services best achieve our organizational mission? How can we sustain our growth, and how can we take our growth to higher levels? And also, what is the next big thing for CNHA? Because again, the current big thing for us is temporary government contracts. And when we find that next big thing, is CNHA prepared to make that pivot? A lot of our government contracts are set to sunset at the end of this year. Moreover, monies generated from these contracts are on a one-to-one reimbursement on qualified expenses. So what that means for us is that the use of our funds are extremely limited. But there's one thing that we can definitely do with these funds, and that is to build our capacity for the next big thing. So what we have been doing here at CNHA is that we've been investing in a lot of things that we're currently doing and building out our IT infrastructure, hiring additional staff, implementing and onboarding more robust accounting software. We're also investing in marketing and PR as well as beefing up our policy initiatives out there. So we're doing all of these so that we're very much prepared for the next big thing for CNHA. And there are a few things that we're now looking at to venture into. And one of the biggest thing is tourism. And we're trying to get ourselves in the business of tourism here in Hawaii. And actually in the last 6 months, the State Hawaii Tourism Authority awarded CNHA a 5-year, $100 million contract to market tourism in North American market. But there's just too many people here in Hawaii who are not very comfortable having a Native Hawaiian organization lead tourism here in Hawaii, such that there was quite a bit of individuals out here who didn't want us to do tourism, that the award itself was taken away from CNHA, but that doesn't defray us from engaging again and pursuing the new RFP, because they again put the RFP for tourism here at the state of Hawaii. And the other thing also is that we're delving into the affordable housing market, and this is really aligned with our mission, and we have the capacity to pursue affordable housing market, and we're leveraging on our experiences with the rental utility assistance program that we have been running on behalf of the city and county of Honolulu, the state of Hawaii, as well as the Department of Hawaiian Homelands. So overall, just like what Julie said, when it comes to our financial strategy, we're aligning it with our organizational strategy as well as our organizational mission. But for us, again, it really starts with an introspection in the midst of growth, just to ensure what those missions are, what the best services and programs that we can support and invest using our hard-earned cash to be able to better achieve those mission that we have set for our organization.
Great, thanks, Ian. So regularly monitoring financial performance allows an organization to proactively identify and mitigate any potential problems. Dana, what are some key performance indicators or KPIs you track to monitor the financial health of your organization, and how did you select them?
Well, I'm going to pick up to where my colleagues left off, which is really, it begins with your business plan and your budget for the year. What drives our financial performance is really our loan outstanding balances and our net interest margin. And from there, a series of sort of KPIs, if you will, fall out of that. And of course, there's the normal of monitoring your budget on a variance basis monthly in terms of your spending. But where the vast majority of what drives our success is, are we closing loans? How are we funding the loans? Because we have a myriad of product types that fund differently. Are we seeing early or late repayment? So that we can forecast what those balances are. So there's a lot of attention paid to that. We reforecast monthly, and we ask our portfolio management team to recast the entire portfolio once a quarter. We don't make them do it every month. In terms of the key indicators, then we're always looking at our fixed to floating rate debt that we're borrowing to look at those costs. We're looking at both the drawn cost of funds and the undrawn cost of funds to make sure we're maximizing and using the cheapest sources of money first. That's my scorecard, to make sure that I'm deploying properly. I should say, as a backdrop, we fund all of our loans on a fixed rate basis. And so understanding our floating to fixed rate exposure becomes really important to us in times like this. And when we talk later on, we'll talk about some of the adjustments we've had to make in this interest rate environment. We're looking at our duration gap with a particular emphasis, if we are borrowing on longer term basis, to what percentage of that gap is actually prepayable without penalty, so that it really shouldn't be counted against you if you've got longer term funds, and making sure we're making that argument to investors and others, versus which portion in fact does have a prepayment penalty associated with it. Net interest margin is a critical KPI by both the current book by product, depending on how you fund. We're using different sources of money for the different lending types that we put out there, but also looking at the pipeline coming in, and making sure that, and that is something that has stepped up significantly, where we could sort of offer general pricing and adjust quarterly. We're now doing loan level pricing and looking at how long that pricing quote will stay outstanding. In past days, we've been a little bit more forgiving about, okay, your commitment's out there for 60 days and then you can close, and these are what your timeframes are. And if somebody's gone 90 or to 120 days because something's changed, or somebody else has been slow in the deal, we've allowed them to do that. In this interest rate environment, we can't do that. And so we're monitoring KPIs actually now around the pipeline that heretofore we wouldn't have done. So those are just a few of the key things. We keep a dashboard, credit quality, I think all of the other indicia that you would think about and trend and look at, our allowance for loan loss reserve, and if there's any change impacting that, which will ultimately feed through to the financials. But those are the key indicators that I would highlight for you this morning.
Great. Thanks, Dana. So we've talked a little bit about kind of developing a financial strategy, what performance indicators we all look at. I want to come back to something Julie mentioned about being nimble, right? So you manage, Julie, a CDFI located in Silicon Valley. With the recent collapse of regional banks like SVB, Silicon Valley Bank, and Signature Bank, what's top of mind for you right now? What actions are you taking, and what would you recommend other CDFI financial managers take to proactively mitigate any potential risks?
Sure, happy to talk about that. First of all, here we are just saddened by what's happened with the banks. Many of you know that Silicon Valley Bank has been an outstanding partner in community development, and we were talking about this earlier, particularly in affordable housing lending. And that team is highly respected and have been a critical member of our ecosystem. And our hearts go out to them, and we know they're working really hard right now. So what we've been doing is really reconfirming our cash management investment policy. We're finding that it still makes a lot of sense. It was built on the same premise that public companies would have theirs built on. I'm not sure what some of those large public companies were doing, saying that they had too much cash locked up in Silicon Valley Bank, but they should have had a strong cash management investment policy. And the top goal in such a policy is preservation of capital, and along with that, liquidity for your operations, and for us, liquidity for the commitments for lending. Depending on the size of your CDFI, though, I know some are required by bankers to keep cash if they lend it to you. I would say now, if they're requiring you to keep more than the limit of $250,000, it's time to talk to your banks and say, we need to do something else. When I arrived at Housing Trust, we had a lot of those bank accounts set up, and so I closed a lot of them after talking to the banks, and then put together this cash management banking policy as well as an investment policy. And this policy is approved by our board of directors. I think if you take it all the way to the board of directors, you have like support for what you need to do in case people want to veer off for some reason, which I don't expect in CDFIs, but I think it happens in public companies. And these policies then are reviewed by your finance committee annually. That's how we do that. And again, like I said, the first goal is preservation of capital, and then liquidity for operations, which you should plan on keeping 3 to 6 months of operations and cash equivalents. And then, of course, planning whatever you need for your lending forecasts. And of course, we all know, at least in affordable housing, it's a very, what we call lumpy cash flow. It is a little bit hard to predict, which is a good reason for keeping things on the shorter side. One way to deal with all this is to deal with your liquidity is to keep bank accounts at a variety of banks. But it's important to weigh that against all the effort of reconciling bank accounts. Your banks can offer a CD ladder product that works well, especially now that there's interest to earn. I have found that the bank CD ladder products you don't earn as much, but again, your goal is not to earn the most revenue. And the CD ladder product does have some extra accounting. The CDs will fluctuate in value month to month, but if you're planning to hold it to maturity and it's 250,000 or less CD, banks will put those together for you. We have a cash management bank where we have a sweep account that pulls the funds into a government money market fund each night. So that's government and very secure investments. Again, it's a money market fund, so it funds it's available daily. Now in the Great Recession in 2008, there was one money market fund that did not. It wasn't able to settle it with the NAV of $1, but I've heard that 98% of the money was recovered on that fund, and I think generally you can ensure that money market funds are relatively safe. We have another bank we use that runs a loan pool, some loan pools we had, and they offer free services to us, so we tend to use those and keep about 250,000 there on a daily basis. Then we also use a brokerage firm, which I'm not sure I would always recommend, but I highly trust this broker that I've worked with for many years. And he's also an expert in cash management and treasury, so he gives us lots of good advice. And in that account, we have 3 different money market funds now, because I think we've got about 30 million in money markets. So that's spread out, even though we're saying money market funds made of government securities are relatively safe, or considered safe. And then we also have a ladder of U.S. Treasuries. In my policy, I can go out to 2 years. That's because I've got some highly restricted funds that I don't know that I can use in the coming 2 years. But right now, I think my ladder's only out to a year. So, keeping it short is fine. We're trying to preserve capital. I don't know if I have any more time. I'm happy to answer questions later. I think that's probably enough advice for today.
No, thanks, Julie. That was super helpful. So Ian and Dana, what adjustments have you made to your CDFI's processes and controls to build resiliency during these current economic headwinds? Ian, let's start with you on this one.
Sorry for that. Again, everything that we're doing here at CNHA is really in the midst of unprecedented growth. So for that reason, building our resiliency is about managing and sustaining growth through improved processes, better controls, and having the infrastructures to improve workflows and tools for management and the board to make better and quicker decisions. So pertaining to processes and controls, first thing that we have done is really brought in additional staff, and we have restructured our teams such that, for example, we now have designated accountants for our loan fund to manage the books and generate loan fund specific financial statements, which we have never done in the past. And all of these are being done by our accounting staff independent of the loan fund staff. At CNHA, we actually might surprise everybody that we only have 4 loan staff managing close to $20 million, while out of those 4, we have 3 underwriters who are cross-trained to do underwriting across all of our different product lines. But I have each one managing and is in charge of a product line or a set of products to streamline underwriting and overall processing of loans. The other thing that we have done is that we've moved to a more sophisticated accounting platform to ensure we can better track revenues and expenses and overall performance of our CDFI as well as our organization. And this is key because we have over 50 funding sources and we have over 100 staff working across many different programs, and pretty much all of us are wearing multiple hats. And the dynamics that we have created between our accounting team and our loan fund staff is in such a way that our accounting teams are now providing checks and balances on the day-to-day activities of our loan fund staff. And also, we do have standing committee meetings between our loan fund staff and accounting staff to ensure that we're keeping track of our loan funding, our loan loss reserves, as well as the level of available funding that we can deploy out into our community. This is quite important for us because at any given time, we have 160 to 250 completed applications in our pipeline, which is valued at around $10 to $15 million. And again, we only have at the most at any given time, $5 to $7 million available for relending. So with having restructured our teams and bringing in a more robust accounting software, what we have accomplished is that financial reporting has been more timely, more accurate, and more complete for management and the board to make sound decisions and to be able to respond to the many different variables affecting our business today. Also, while it is not yet finished, what we have also done is integrate Salesforce in our workflows. Implementation of Salesforce here at CNHA is being done in a piecemeal fashion, starting with the biggest programs, and then ultimately we're moving into our loan fund. And we hope to accomplish with Salesforce a single platform that will tie all the different software that we currently use on a daily basis, such that processes that are housed in Down Home Loan, in LenderFit, in Sage Intacct, will now be able to, for our staff to be able to access from one single platform, and hopefully that will be Salesforce. But also, I have to admit, there are quite a bit of things that we're still trying to tackle here at CNHA. And for many of our colleagues here today, these things that I'm going to mention may sound very rudimentary, but for an organization that really took off in the last 2 years, I'll say it bluntly, we have not had the bandwidth to address some of these. First and foremost is the policies and procedures that we currently have. This needs to be updated. We want to make sure that we're incorporating in our policies and procedures the best practices that we have seen thus far or we have experienced through the past 2 years. But also for us to be able to incorporate new policies and procedures to be able to implement those policies in this environment with new challenges coming at us. So we want to take the opportunity to make sure that we're ready and we have a blueprint for our staff to be able to address issues, challenges that may come about or are happening right now in our business environment. The other thing that we would like to accomplish also is for us to be able to go into the community, do a needs assessment to figure out whether our product mix are actually relevant to them, or are we just simply forcing individuals on loan products that they may not need? Because this is a situation where we tend to tackle quite a bit of applications, but they simply are not relevant to our loan products. So again, one thing that we would like to accomplish here at CNHA is to conduct a needs assessment to figure out what type of product mix is the right for our community. So those are the things that I wanted to share to everybody. Some of them may sound very rudimentary and basic, but I hope that there are colleagues of mine out there who may be in the same situation as us and are able to relate to what I have just shared with you folks.
Thanks, Ian. No, I think kind of having that strong foundation and making sure that that is in place is absolutely critical. Dana?
Well, I think it was Charles Dickens who said it was the best of times and it was the worst of times. And one of the fundamental things that we've changed is we've been pretty ruthless about not keeping excess cash, but driving down our net interest rate margin by, of course, paying off debt that we don't need. With the rising interest rate environment also comes opportunities, particularly, Julia, I'll leverage up something that you said, which is we've been doing T-bill laddering with our excess cash because that excess cash is now earning more and we're getting positive arbitrage over the underlying cost of borrowings. And that's not something that had existed during the time that I've been here until now. So it's a mixed blessing, right? Higher interest rates doesn't help some folks, but it can certainly help your interest income returns. So that's certainly one big piece of it. The other part of, I guess, the worst of times is, and to go not just focus on interest rates, but fraud has been a prevalent issue. And so one of the things in our cash management policies that we've done and in our insurance policies is making sure that we have all of the safety features, and I hope everybody does on their accounts. Whether it's positive pay, and making sure that you're paying for the full positive pay, meaning check your payor, your check number, the amount. Somebody recently found out that they had some of those services, but not all, and still had a fraud event go through. Making sure that you've got your cyber coverage in place, and that you've got multi-factor authentication so that you can get your cyber coverage in place. Small learnings across sort of IT, operations, and treasury that became and have become really important in terms of this current interest rate environment. We have a normal practice of updating our policies every 24 months. And so I guess it was fortunate that the financial policies came up recently. And so that gave us a chance to look at many of these issues. We do have a cash management and treasury policy. We did upgrade those to reflect some of the changes in the current environment, including holding more cash and how we would do that. Julie, like you all, we do use a broker, and we've had some great advice from that broker over a long-standing period of time. And I think when your cash balances get to a certain level, we're certainly doing more detailed cash projections so that we can always make sure we have the funds that we need to have available, but that we're laddering and I think from a fiduciary standpoint, getting the best that we can with principal safety as the primary concern in our investment strategy. I think, as I mentioned in our interaction with our sales teams, our loan officers, it's been different, and they're still getting used to it over the course of the last 3 to 4 months, which is, we're engaging around their term sheets, and even before that, letters of interest going out the door with folks to provide pricing feedback relative to the capital that we're going to be providing for those loans. Wherever possible, we try to disintermediate and absorb some of that cost of funds, that increase in the interest rates, by being hopefully smart in terms of the way we borrow and passing that through to our borrowers. But that requires more involvement, and loan originators don't always like that involvement. And then finally, we have increased our request for grants. That is not something that we had heavily focused on, but with we borrow on an unsecured basis with 18 different investors. If I had a hat, I'd hold it out and say we've been knocking on everybody's door and making sure that we're in everybody's grant application radar, so that we can again continue to drive down cost of funds so that we can lend to our network in a cost-effective way for them while still maintaining our net interest margin. So those are a few of the adjustments that we've made in this environment.
Great, thanks, Dana. So this question is for the whole group. CDFIs have earned a reputation for being financial first responders by stepping up to provide services and capital to those who need it most during disruptive times. So how are you positioning your CDFI so that it can continue to meet the needs of your communities, the communities you serve? Julie, why don't we start with you?
Yeah, I mean, for us, certainly the interest rate disruptions has hit our borrowers. We've been fortunate to be positioned with some low-cost fixed capital. It's not going to be around forever, but we have it now, and so we're able to offer some lower rates and maybe fill some gaps for those borrowers when they hit these interest rates. Interest rates hit their projects and create gaps. So that and some grant money that we have, we're able to fill some of those gaps. And And then there's just ecosystem changes here in the affordable housing market, and so that's requiring us looking at new loan types or revisiting loan types we've made in the past, which means we have to adjust. It's going to be more complex thinking about what capital we have now, how do we fit those into those new loan products, and then where do we go to raise new capital to fit the new needs, the new requests coming in, and anticipate what we might see happening in the coming years. We're also talking to our investors. We have a couple large investor lender partners, and we want to help them to stretch the way they're thinking and about how we can match their capital with the new needs. And some of the grant capital also, we have to work with our grantor to maybe expand the type of loans we make, because again, the ecosystem's changing. There's new demands from our borrowers. So those are some of the steps.
Great, thanks, Julie. So Ian, how is CNHA positioning itself to best serve the communities that it represents?
For us, it's really about lowering the cost of loan for our borrowers, and for us to be able to do that, first and foremost is really to diversify our sources of capital, and to ensure that as we bring in new monies, the interest rates are very modest. And I have to admit, as I go out there and ask funders and banks for new capitals, I'm insisting nothing more than 2%. And I've learned in my early career in the nonprofit world that if you don't ask, you won't get. And I'm not shy at all in asking immediately from the outset during initial talks that we can't do anything more than 2%. And any new loan, any new capital coming in, it has to come with at least 10 to 15% grant. And those numbers work for us, and they work for our borrowers. And if we can't get those, I'm always prepared to walk away and move on to the next one. Because again, we know what works for CNHA, and we know what works for our borrowers. So we do know what our comfort level is, and we need to be prepared to walk away if we can't get those. It's very difficult. It's tough when we get into bed with funders and we end up dragging our feet with, difficult interest rates to meet. So again, be prepared to walk away if ever you're unable to get things that does not work for your organization. But the other way that we're lowering the cost of loans for our borrowers is that we have been recapitalizing our portfolio or portions thereof, because doing so allows us to generate fresh capital without having to get ourselves into more debt. And also additional transactional costs or operational costs that are associated with the expansion of your loan fund. So again, just working with local banks or bigger CDFIs that are able to come in and take on some of your loan portfolio is a great way to generate new loan capital. The other thing also is that here at CNHA, we've been able to tap to our local financial institutions for us to be able to put together new programs of which they're helping to fund. One thing in particular is that we're putting together a new loan product for women-owned businesses. And in so doing, we have it's going to be a matching scheme whereby we're putting in a certain amount of money, and of course our partner bank is doing the same. But of course, we're, as mentioned, we're already limited in capital. So I have gone out and partnered up with another CDFI who can actually put in that matching fund from CNHA. So we've been leveraging our position, our situation, and I have to admit also our newly found fame in the past 2 years in being able to generate new funds. So, and we all know that, the situation that we're in is quite limited. So we're taking full advantage of the opportunities that are coming in. We'll listen to any offers. But again, going back to what I just said earlier, if it does not work, we will walk away. And it's all in the spirit of making sure that we're providing the best and most affordable loan products to our community.
Dana?
Some of the same themes and a couple of new ones. Same theme in terms of finding the best capital that we can at the cheapest prices that matches up with the needs of our network. And that has led to what I'm calling sort of more boutique capital solutions, pockets of money that have a particular, that the investor wants to get deployed for a particular reason. And so they're willing to do something special for that to happen. That's great because we get some really attractive capital. The downside is it can be administratively expensive and intensive. And so it's something that we have to be mindful for. And so we have, as a side note, invested a lot in our technology with everything, the loan system, our financial system, and our essentially data warehouse, Salesforce, bringing everything together in a way where we can be nimble to do that. We're also at NeighborWorks Capital standing up a consulting firm. We have for years provided technical assistance, both directly and through NeighborWorks America, but we think more than ever, there may be a need for, financial consulting advice, tools to help, be built, cash flow models, it's deal books, et cetera, for our clients. And we have historically had a lot of call for that. We formally surveyed our network and decided it was time to just stand it up as an independent line of business. And so I think that's very much a first responder jump in there. Unfortunately, the calls are coming now more today because we've got a problem, something's not quite working. Hopefully they can go to other things like, hey, can we help you establish capital in a different way? And then with that, I think one of the roles that CDFIs play, and I've been dealing with a foundation to raise some money. And one of the stories they liked most was about our patients. We had a workout, fairly large one, that I think any other lender would probably have foreclosed on the property. And from, a borrower, essentially the CED leaving, contractors leading the project, the tax credit investor leaving the project, you name it, and it went wrong. And I'm pleased to say today it's built lien free with a new investor, and it's an incredible story in a community that needed the housing not to be lost. And that patience, that first responder, let's get in, let's figure it out, and then let's link arms and kind of get through this together, I think becomes a really important role.
That's great. Thanks, Dana. So as we close out the session, I want to ask, what's one takeaway you hope attendees will leave with today? Ian, how about we start with you?
I think it's the the theme that resonated amongst everybody, which is make sure that the capital that you are seeking does work for your organization and it does work for your borrowers. And that is really a mantra that we do have here at CNHA, because again, in the midst of growth, we do need to manage this growth, and not everything that is coming in is going to be viable or supportive of our mission or our longevity. So, be very discriminatory as far as opportunities that are coming towards you.
Thanks, Ian. Julie, one takeaway for the group?
Sure. I think in the timely time that we have is take a look at your liquidity forecasting and your investment in cash, and get your finance committee and board to really understand. And even if it's all in great shape, it's probably a good time to take them through it and use them as partners to ensure you're feeling good about where your cash and investments are and that they're ready for deployment.
Absolutely. Dana?
Well, I had written treasury, treasury, treasury. So I'll flip out of that one since Julie picked it up. And I would say be nimble, be looking at your information and be ready to move and question what you're doing and be willing to do some different things. I think in this kind of environment, doing the same old, maybe the same way is not necessarily the right way to do things. And so question everything you're doing and stay on the balls of your feet. So
That's great. Thank you, everyone. Thank you to our panelists for sharing their insights and expertise, and to everyone for joining this session today. If you're watching this live, I hope you will join us in the interactive Zoom room for Q&A and further conversation. You can access the Zoom room by clicking the Join the Interactive Discussion Group link, which is at the bottom of this page, below the session description. Please give us a minute to switch over to the interactive Zoom room. If you decide not to join the discussion room, I hope to see you all back for the closing plenary at 4:30 p.m. Eastern. Thanks, everyone.